Hello. So, net interest income. What is it and how is it used? Why is it used? In its simplest form, net interest income is just that. It's the net interest income that the bank receives each month as a result of all the business it does. So think of what a bank does. It lends money, which earns it interest, and it takes in deposits, which costs it interest. So the difference between those two, the interest earned minus the interest paid out, is the net interest income. So in itself, that's a simple performance measure. If your net interest income is falling from month to month, you've probably got a bit of a problem. If it's staying reasonably stable, that's okay. If it's increasing, even better. So in that respect, it's a performance measure, net interest income. In fact, it feeds into another performance measure called net interest margin, or NIM, net interest margin, which is basically one's net interest income for the month, let's say, divided by the balance of your interest earning assets. Let's call that IAA, which is not a universal acronym. So that divided by the average interest earning asset notional number is your net interest margin. That's a performance measure. Net interest income is also used as a risk management or risk exposure measure, in that we're interested to know, as I alluded to just now, how much that changes by, or how much it might change by, if general levels of interest rates in the market change. Remember, banks are essentially price takers as opposed to price makers. The rates they set on their products are dictated not wholly, but to a large extent, by what the rates are in the market generally, what other banks are charging or receiving, and what the central bank is charging for its overnight base rate or policy rate. So net interest income is a performance measure, but we're also interested to know how much it might change by if interest rates generally changed. So to do that, we're going to calculate the delta net interest income. How much would it change by if interest rates changed? So we'd start off with a chart looking a bit like this, possibly a little bit neater. So we're going to have each product with a net number. In fact, you can ignore these rows. Let's just say in the overnight time bucket, I'm expected to pay tomorrow, by tomorrow, this much interest and receive this much interest. That'll give a number there. I'll have a number for the next week and the next month, all the way out to 12 months. Let's imagine this is a 12-month metric. Okay, so I'm interested in my net interest income for the next 12 months. Now that is obviously a forecast. We don't know what's going to happen in the future. And my favorite gag on that one is, if I did know what was going to happen in the future, I wouldn't be here. I'd be buying the lottery numbers for the Euro Millions on Saturday night. But we don't know the future. So we're going to forecast what the net interest income is, usually based on our own balance sheet forecast. Finance departments of banks are always producing forecasts of the business, and we assume that what we plan to do as business with customers actually happens. So we can determine with some approximate accuracy, so it's an approximation, how much net interest income we're going to make for the next 12 months. And that will then be summed to give me the total for the year. Remember, it's a forecast. Now, the interest that I expect to receive and pay is based on the interest rates that I set on all my products. If a product is a fixed interest rate, changing interest rates, changing the market rate won't make any difference. But lots of customer products are not fixed interest rate. They're floating or variable. So when market rates change, the bank will change the rate on its customer product, and that will impact its NII. So if I had a completely fixed rate product suite, I wouldn't be worried about the delta, the change in the NII. But because a lot of my product is floating, I'd like to know how much it might change by. So just imagine the rate today was 4.25%. And by in fact, it's 4.5. Just imagine it was 4.5%, which is the base rate in the United Kingdom today. Obviously, that will depend on what country you're in, what the base rate is. But then we also imagine that for some reason, knowable only to them, forgive me, that goes up by, say, 100 basis points, okay? So it goes up to 5.5 basis points. What might that mean for our NII number? The difference between this forecast and the old forecast is my delta NII, and it's a kind of earnings exposure measure. In fact, some people use the expression EAR, earnings at risk. That's an E now, not this sigma sign. Earnings at risk, to describe how much their NII might change if interest rates in the market change, hence NII. So that's one of the two measures of risk that is used as part of managing interest rate risk in the banking book. Interest rate risk in normal customer business, changes of interest rates will impact your earnings, your NII, and also present value. And there's another separate video on what that means, and the measure there is EVE. So that's the present value measure. The earnings measure is delta net interest income. Great, hope you've enjoyed that. Thanks for watching. See you soon.